Good morning, everybody. Thank you for joining myself and Maria for this session. So we're from Kensington. I'm the National Account Manager, and Maria is one of our fabulous BDMs. I'm going to do a bit of a market update, but with the context in terms of remortgages and the growth that we've seen in that particular part of the market. So I'm going to speak hopefully for about 15, 20 minutes maximum. Possibly, hopefully not longer, although I do have a tendency to probably outstay my welcome. So I'll try and keep it short and sweet. And then what I'll then do is close my presentation and then hand over to Maria. And then we'll open up some questions at the end if you've got them. So thank you so much for joining us today. I know you're incredibly busy. So we're going to talk a little bit about sort of the remortgage market. So that's basically my bit, the insights and opportunities, and then I'll hand over to the lovely Maria. So who are we? First of all, I'm sure you've all heard of Kensington, hopefully used us in the past. We're about next year to celebrate our 30th birthday. So we're one of the longest serving specialist lenders out there and the fastest growing. So we're on course this year to double our completions, which means from your point of view, we should be sourcing pretty well. We'll be becoming a bit more apparent in terms of the lender spread that you use. And we're now owned by Barclays, which gives us some advantages in the sense that we can price pretty competitively. A lot of the growth this year has come on buy-to-let side, which I know Maria will cover off in her bit as to why we're seeing that growth. So yes, it's definitely the fastest growing. So I look after networks and clubs. We tend to be positioned number one or not far off it in terms of size of specialist lenders. So yeah, really positive year this year. And the challenge for us is to retain our top spot and to kick on again next year. So obviously we've got solutions that sit outside your high street really. So it's a bit of fun really, just to put the market into context. The telephone company AT&T in the early 1980s, that's when actually cell phones, the mobile phones that we use and probably operate off most days now, were asked to forecast how many users in the world there will be of mobile phones by the turn of the century. And they predicted that there'd be 900,000. And when we actually play it back, what actually happened is there was 4.3 billion users of cell phones in the world. So the reason I'm sort of telling you this is markets, we love predictions, and I'll make some today, but uncertainty is inherent in our marketplace. And that uncertainty actually drives a lot of the behavior that you see from your customers. And actually drives a lot of the solutions that you see from specialist lenders as well, because it tends to be the economic shocks or the things that surprise us, which do tend to matter the most. So I'm trying to put this uncertainty into context of remortgage a little bit later on, but that's just a little story just to kick off. And there has been some studies on this. So a guy called Tetlock did some research, and he looked at political experts, he looked at economists over the years, and looked at, okay, when they make a prediction in terms of what's going to happen in the future, an example in our market would be on Bank of England base rate, where interest rates are going to go. That's what your customers ask. A lot of the economists, they make predictions, excuse me, but apologies about that. So they make predictions in terms of where the market's going to go with a confidence of 53%. So they look at all the data and they account for some error and unpredictability, but they're actually right only 23% of the time. So I think that's important just to sort of say that although the market is very resilient and interest rates on the whole have been coming down, which opens up the whole market in general, including remortgages, there's always something that comes along that surprises us and drives the market in a really different way. And the Bank of England are really aware of this. So if you were to sort of just only a few months ago and ask how many interest rate cuts are there likely to be, the general consensus was probably a lot more than there's going to be right now as we look at it today. So they actually use a uncertainty index when they make decisions on Bank of England base rate. So there's lots of things that go into this, lots of sources that go into making that decision. And there's a recent speech by an NPC member, Dave Ramsden, navigating the uncertain outlook and the signals from the labour market. And that orange line that you can see is trade policy uncertainty. So that's all the stuff that's going on over the pond with tariffs and things like that. And all of this adds into the uncertainty index in terms of how they make decisions. So what they've seen is the UK's been hit by multiple shocks over the last decade, and you can probably think of some, COVID, the war in Ukraine, inflation spikes, cost of living crisis, etc. And they tend to actually, in a weird way, kind of halt the market, but then customers tend to either lose jobs or take on extra debt and this type of stuff. And it drives, as the market recovers, it does drive specialist lenders. And we'll come on to some of those stats a bit later on as well. There's a great market commentator, thoroughly recommend that you read some of his books, called Morgan Housel. He wrote The Psychology of Money and a recent book called Same as Ever. And there's a line on there that he said that we are very good at predicting the future, except for the surprises, which tend to be all that matter. So bringing it back into the whole topic of remortgages. So at the start of the year, UK Finance set out their predictions of where the market's likely to go. And they felt that because of the general trend of rates coming down, improving affordability, that the biggest growth area would be remortgages. So the purchase side of the market is the biggest. But in terms of the biggest growth area, they predicted that there'd be a 30% increase compared to 2024. And we've got some data that we've got from our parents in Barclays that I'll share with you just to sort of back that up, that they're not far off that prediction, actually. When you add the internal product transfer market to the remortgaging market, it's actually a bigger market than the purchase. And arguably, given the uncertainties that I've spoke about, looking after your existing client bank is something that you can absolutely control. So that's just something to bear in mind. And if you look at 2026 predictions, again, they're expecting a big uplift in remortgages as rates edge down. So we've gone from 76 billion to 82 billion. And then you can see the purchase market is flat compared to that. And again, it's like cooling, but still a massive opportunity in the PT market. So as rates come down, we'll see more remortgages versus the PTs. And if you look at going back in terms of records, so the remortgage market back in 2014 was 45 billion. So you can see how much that has grown over the years. And I did some sort of reckoning last night. So since 2014, although the remortgage market obviously ebbs and flows depending on what's going on out there, there's only 2 years that I could see that had significant dips in remortgage activity. So that was 2020 spiraling into 2021 and then 2023. And you can just sort of drop a pin in terms of pandemic and then war in Ukraine, cost of living, inflation spikes, which obviously cooled the market there. But outside of that, it has shown significant growth. We get a lot of data in terms of illustrations from 27 Tech. So in July, 27 Tech actually recorded the smallest ever gap between purchase and remortgages in terms of searches that you guys are doing. Obviously, not all of those remortgages will go ahead in terms of applications, many of which will actually be a product transfer. But it's really interesting that that's a more significant part of the market, and really, really important that you speak to clients early as you can into the mortgage cycle. LMS produce a monthly remortgage snapshot. So every month we've actually seen an increase in remortgage activity. August was actually the first time this year where we saw a bit of a decrease. I don't think it's anything to be alarmed over. We've seen that seasonality of holidays, etc. So we saw a 28% decrease in activity versus the previous month. The one thing just to keep an eye on, I think there's a lot of uncertainty out there speaking to brokers and networks around possibly the budget next year and different views on what's happening with interest rates. So just keep an eye on that cancellation rate. So they have reported a slight increase in cancellation of instructions. So again, it's too early to tell in terms of anything significant, but that's just something to keep an eye on. And if we just sort of move on in terms of zoom out in terms of an overall market, what you can see on this slide is that you've got the averaged 2-year fixed at 75% rates edging down. And then the blue bars are the weekly application volumes that we see, and this is from data from Bank of England and CACI. So what you can actually see is that as the rates have edged down, the overall applications in the market has actually started to increase. You see that relationship between interest rates and activity. The purchase part of the market, as I mentioned, is the largest part of the market, and that's still really positive despite the fact that the stamp duty deadline's passed. But again, going back to the UK finance predictions, what you can see on the bottom left-hand side is the buyer journey year-on-year change. So the remortgage market has seen a 24% increase versus the previous year. Buy-to-let, despite all the doom and gloom in the news, has seen a 20% increase, and that's something we're feeling at Kensington is the biggest growth area for us. But you can see that remortgage market as rates come down being really, really important. Now, of course, not all loan to values are created equally, so that 60 to 70% LTV has seen a huge increase this year. It seems to be a key battleground for lenders, obviously lower risk, the rates obviously really attractive, and customers looking to sort of balance the cost of living, and they're looking for better deals, etc. But that has seen a massive increase. It's also pleasing to see increases at the top end of the market. Big part of what we do at Kensington is over 90% for first-time buyers. The relaxation of affordability rules, etc., is obviously playing a part there. We've seen a 15% increase in the over 90% market as well. So that's really, really positive. In terms of remortgages then, so the PT market still remains a big opportunity. It's been a big year this year for product transfers, and what you can see on the bars there as we head into next year is that 2026 is going to be a significant year too. So you've got some bumper quarters in Q2 and Q4 there. The dark bars are residential, and the light blue bars buy-to-let. So again, it's a big opportunity for everybody on this call to make sure that you're ahead and looking after existing customers. In my previous role at L&G, it was quite common from the high street lenders to tell us that a good chunk of product transfers carried out through the intermediary channel were done by a different broker than the ones that were originating that deal. So if you're not looking after your existing customers, another broker will recognise that and probably try and pinch them. So that's really, really interesting. And then what you've got this year is a bit of a tale of two halves in some respects. So you've got remortgage, you've got customers rolling off fixed rates from 2020, which were like super cheap. One of my contacts actually for another network is seeing an increase next month of £400 on his mortgage. So luckily they can weather that because they've come from super low rates. Although rates have improved recently, they're a lot higher than they were 5 years ago. But you're also seeing customers coming off at higher rates following sort of the Trussonomics episode in 23rd of September 2022. And you're actually managing to actually potentially save some customers some money. So the opportunity there, because it's quite complex, is to just get in front of these customers and see if you can help them. But it is a really interesting market in that respect. And I think the start of next year, we will see some of those continuation of some of those customers coming off those cheap 5-year deals. To the specialist lending residential market, we're definitely seeing an improvement in demand as affordability improves. So what you can see on the left-hand side is the specialist lending residential market pitched against the total residential lending market. So we've seen an increase as rates cool. So that's ourselves and our peer groups from an illustration perspective. And then again, really strong at the top end of the market with a 47% increase of that higher LTV stuff. So again, it's just sort of making sure that these track through to applications for us, which so far so good. And then buy to let, despite all the news, is a big growth area for us. We've seen increased competition, so we will need to kick on again in order to maintain a growth. We've seen Lloyds Banking Group come into that market, Coventry this year, and others into the limited company market. So we launched our prime range, which I'm sure Maria will discuss in the next session. Responsible for 40% of our growth, and actually you can see it's a big growth area for lenders to consider. So the limited company buy-to-let market is growing 90% year on year, and now accounts for 20% of all new buy-to-let lending, which is phenomenal. And research by Hamptons actually shows that just last year alone, there was 60,000 companies set up for the purpose of renting out, which is huge, really. And if you add that together, there's more limited company set up last year for the purpose of renting to people, and that's more in 1 year alone than the entirety of the number of takeaways in the UK, which is, when you put it into context, that's a phenomenal statistic. There are obviously government announcements on housing. I'm not going to go into all of these in a lot of detail, but in terms of the future of remortgages, there's a lot of uncertainty around the green agenda and what the government will do there in terms of kind of improving EPCs or mandating EPCs. We know it's been put on hold. It may come again. So again, these are opportunities that if and when these things come into fruition, you can actually have a clear plan with your landlord, or indeed any of your clients looking at making changes to your property at that point, in order to help them. So again, uncertainty, we need clarity, but that'll be an opportunity if and when these things come into fruition. And then I just wanted to talk, without scaring you, on the regulation side of things. So we know there's been a discussion paper that's gone to market. It's closed now. A lot of distributors have fed back, as well as trade bodies, Amy and Imler. So this is around the regulator looking at making things a bit easier for customers to facilitate a remortgage. They recognise that 80% of customers end up staying put with the same lender, despite the fact that possibly there's cheaper options elsewhere. So why is that? Now, there are trade-offs to this, and there has been a lot of uproar in terms of what's actually best for the customer, because there is a suggestion that the regulator is looking at maybe encouraging execution only to come, to make it easier for customers to facilitate a remortgage without jumping through affordability hoops, etc. If you go back to that slide around the most popular products in terms of that 60-70% bracket, my question, if some of this comes into fruition, and again, it's a big if, which customers are likely to go direct to a lender versus through intermediaries? And that's why I think actually intermediaries focusing on specialist solutions, more complexity in the market, looking at structuring, complex buy-to-let, structuring customers with complex income. That's the type of activity I believe that is arguably future-proof and is less likely to go directly to a lender. Again, it's a big if, but in terms of future planning, we've got a PT and remortgage market which will continue to grow and potentially, depending on external factors, be a bigger part of the market moving forward. But then a chunk of that, if it goes directly to a lender, where is it that you can come in and actually help customers? And I think it's those complex circumstances that will give you the biggest opportunity. And that is me wrapped up. And then I'm going to stop sharing my screen and then hand over to the wonderful Maria to go through some of our solutions in terms of how we can genuinely help clients today. So I'll just stop presenting.
Thank you, Adam. That was very, very informative. I was really enjoying myself there and thinking.
I'm glad one of us enjoyed it, Maria. Thank you.
I could take a back seat there. So good morning, everybody. As you know, I'm Maria, your local BDM. So if ever you've got any questions or any cases to discuss or any credit files that you'd like me to look at, I'm more than happy to take a look to help you, because I appreciate going into the adverse world can be a little bit complicated, and sometimes it can be we ask a few too many questions compared to some other people. So what I'll do is let me just run through my presentation with you. What I'll do is I'm going to touch on buy to let to start off with. First of all, one, it is my favourite subject, and two, it is it is something that since we've had our buyout from Barclays, it's an area of growth that Barclays would like us to look at. Can I just check that, whoops, can I just check that everybody can see my buy-to-let overview?
Yes, we can see it, Maria.
Excellent, lovely. Thank you, Adam. So just to make life a little bit simple for you, I just wanted to give you a brief overview because basically we have two product ranges now for buy to let. One is called Core, which is our existing product range, and the other one is buy to let Prime, which is primarily the money that we got from Barclays to do something what I would call, it's for very, very clean clients. Now, you probably all know that most of your buy-to-let landlords probably don't have any adverse in the background, but every now and then some of them might get, you know, a default because of water or electricity or a parking fine or what have you. So a CCJ for a parking fine. So those are the sort of people that will end up going down the core route. But I just wanted to let you know what the main difference actually is. So if you come to Kensington, Buy-to-let Prime will always give you the maximum affordability because this product has got the lowest stress rate. So this product will be stressed at 5% or pay rate, whichever is the highest. It has a maximum LTV of 75%, and currently the only products that we do offer are 5-year fixed rate deals. The other area that you need to be aware of is that we have put a minimum valuation on the buy-to-let Prime. So your clients' minimum valuation for the property would be 150,000. Now, when you look at Core, the stress test is slightly higher, but I guarantee you it fits in certain areas. One, if you've got clients who are purchasing up north because the property market is a little bit cheaper, but the rental figure is much more, gives them a bigger return. That fits on the buy-to-let Core range, and also HMOs will fit on the buy-to-let Core range. Now, the minimum valuation on buy-to-let Core is 100,000. The stress test is slightly higher. I believe the stress test is something like 6.6%. or pay rate plus 2%, whichever is the highest. However, buy-to-let Core does offer two-year deals as well as 5-year deals. Now, just wanted to let you know of a couple of areas why to come to Kensington. So we don't have a maximum age. So your clients can come to us at the age of, I don't know, 80 and want to do a 40-year term. That's fine with us. That's the oldest applicant I've had so far. So bear us in mind that we have no restriction on the age, and obviously then it doesn't affect the term neither. The other thing to bear in mind is that we can look at your first-time landlord, non-owner occupier. Now, if they do not own their own residential, the minimum required normally is 40,000. So one applicant would need to be owning 40,000 in order to qualify for a first-time landlord, non-owner occupier. However, if they live in tied accommodation that's been provided by their employer, they do not need the 40,000. And also, if they've also had a property that they've owned for 2 years, but have now started to rent it out and gone back to live with family or with a partner, then again, they don't need that requirement for 40,000. So we've just tweaked that a little bit to make it a little bit easier for clients with different profiles in life to come to Kensington. So obviously, like Adam mentioned, the biggest growth area is limited company buy to let, and we do see a lot more SPVs coming into us at the moment. Now, obviously, we do like them to have the relevant SIT codes to hold properties in, but if they do have some other SIT codes alongside the main ones, give me a call, because the chances are we can still deal with their application, whereas other lenders such as TML would actually insist that they only have the minimum SIC codes that are required to hold property. So again, please reach out to me if you've got something that's a little bit out of the norm. Now, again, if you have a client who's got a limited company application, we can do up to 4 directors. There's quite a few lenders out there that will only allow 2. Now, one of the things I always say, and I always get asked, is how do you deal with people with the different shareholdings? So for us, if you had 2 directors who had A shares at, I don't know, they had 30% each of A shares, but then they have 4 children with alphabet shares in the background, we can still help them because those clients have 100% of the A shares. The 2 directors. So the directors must own a combined shareholding of 100% of the A shares, regardless if there's any B or C shares in the background. Again, if it's a little bit confusing, please drop me the limited company details. I'll always check it on Companies House, and I'll be able to talk to you about whether we can do that deal for you. Now, one of the best USP, shall I say, of coming to Kensington is how we treat limited company directors. So, or directors, shall I say, let me start again, portfolio landlords. So if you have a client who has a large portfolio, Kensington look at it very, very favourably. So for instance, you have a client who has 10 buy-to-lets, they have 8 in their personal name, and they've got 2 in a limited company. If you wanted to do a new purchase in that limited company, Kensington will not require anything to do with the properties held in the personal name. So we won't stress test those. We don't want them on the portfolio spreadsheet. And also the best thing for you is we don't need a business plan or an assets and liability sheet. So basically all you would need to do in that circumstance is put the 2 buy-to-lets that are owned in a limited company, and then we will assess the new one that's coming to us. So regardless of how many limited companies you have, we're only interested in the limited company that's coming to us and the assets that are inside that limited company. So 1, it helps you completing the application form. 2, it helps you with the portfolio spreadsheet. And 3, it means that if your client has got a portfolio that's a little bit under the water, we're not going to be factoring that part of it in. So this is one way that we can help you with your clients with large portfolios. Mentioned earlier on, Adam also mentioned about the marketplace, but also I've noticed that I'm getting an awful lot more HMOs. It might be because I'm very close to Brighton, so we do have a lot more a much bigger university now, but we are seeing a lot more HMOs. I do appreciate there are starting to become a lot more restrictions regarding HMOs as well.
You say it properly.
Sorry, say that again. Sorry, did you ask me a question? Okay. So with HMOs, we've seen that this market is starting to grow quite a bit. So with HMOs, we can do up to 6 rooms, and we can also look at multi-units, which have 6 units. One of the best things that's actually happened to us this year is our conversations with Connells. In the past, Connells would only give us the details of if the property was resaleable as a family dwelling. However, we had a lot of landlords that were doing quite nice things to their property, i.e. putting en suites in every room. That meant that properties weren't readily available as a family dwelling because what was the lounge and diner had been converted to a bedroom with an ensuite. So technically nobody wanted to buy a property with a lounge with a ensuite in it. So basically Connells have now changed how they do evaluation, and so Connells now have to say whether a property is readily available as a family dwelling or there is a demand for HMOs in the area. So again, this will actually help you quite a bit with your clients when it comes to HMO properties. Also, we will look at the rental income from each room for the HMOs, but we will still give you a bricks and mortar valuation. Has anybody got any questions about what I've just mentioned about buy-to-lets? Would anybody like to ask me any questions on that? silence is golden. So I take that everybody was happy with what I said. Now, one of the other areas I want to talk about is residential and where we can help you with residential. Now, I always get people that come up to me and go, I just deal with vanilla. I don't deal with your type of business, Maria. And I'm basically sort of like going, what do you class as vanilla these days? Because vanilla isn't vanilla like it used to be back in the day when I started doing mortgages. Vanilla now is still very, very complicated. So I appreciate the high street can offer quite a lot of things for you. However, you might get situations where you find that clients are they've not got a very good credit score. That might be because something is historic. It might be because you've got a first-time buyer that basically doesn't have much credit, and that really, really does affect these poor first-time buyers because they can't get onto the high street because they've not got enough credit to get a good credit score. Or you might have a client who's got too much debt in the background, and again, this is affecting them with a credit scoring. So at Kensington, the good thing about this, and I can't seem to find my sheet for credit. The good thing about that for Kensington is how we will look at credit. So one, we do not credit score whatsoever. All we're interested in is we look at the client's profile on Equifax. That's the only search engine we use. And we look at that and say, does it meet our criteria? So just to make it simple for you, the criteria basically is, did they have a CCJ, any CCJs or defaults registered 24 months ago? If that is the case, it doesn't matter if they've been satisfied or not. We can still consider them up to 90% on the core range. However, if you've got a client who had CCJs or defaults registered 36 months ago, they will fit under our primest range or cleanest range, shall I say, which is our select range. That goes up to 95%. However, just if you have got a client who goes above 90%, their CCJs would have had to have been registered 72 months ago. And when it comes to unsecured credit, we're only interested in the last 12 months. So as long as their status doesn't go above 2, we're happy to look at them. Things like communication defaults we'll ignore. We'll ignore utility defaults up to £250. We will ignore bank account, ignore bank account defaults as long as there's still no more bounce DDs. And we will ignore insurance defaults too. Now, we have some other products that can look at more recent credit issues, but I don't want to go into too much detail on that. Now let's go back to why we actually had this webinar in the first place. It's all about remortgaging. So remortgaging is a massive, massive growth area. And one of the things that I can help you with is how we look at debt consolidation. So we can go right up to 90% for debt consolidation. And the best thing about coming to Kensington is we do not have a debt to income ratio. So what I mean by that is you've got a client earning 50,000, he's got debt of 90,000. Most of the high street lenders will go, oh, not quite sure about that because we'll only do 50,000 debt consolidation and the other 40,000 can only be used for home improvements. Or you might get a situation where a client has had a bridge or a second charge, and basically that then affects the debt to income ratio because they don't factor those in as like a mortgage, they factor them in as debt. So again, this is an area that we can help you with because we're not going to restrict the debt to income ratio. If they're paying off that debt and it fits the affordability, happy days, we're happy to look at it. So it's an area that I think if you're struggling with the high street, this is an area that we can actually help you with. Again, if you've got anything, please give me a call. I'm more than happy to look at you. Just touching on some other areas, by new builds, we can do up to 90% for flats and houses. If you've got a flat, we can a second-hand flat, as I like to call them. We'll obviously do a flat at 95% as long as it's not a new build. We do shared ownership, help to buy in Wales, and right to help to buy remortgages if they still want to keep the help to buy in place, and right to buy. And we are with Own New, which is the new build rate reducer. So instead of getting the 5% builder gift, you get it reduced off your rate instead. Works very well for a specialist lender, because our rates will probably around about 6%, but the own new rate reducer will be around about 3%. Couple of other areas to help you with as well. Like I said, vanilla is vanilla in lots of different ways. Self-employed is an area that you probably go to the high street all the time with, but they can be a little bit funny with some self-employed applicants. But at Kensington, I think we've got a really, really nice approach in how we look at it. One, because I mentioned earlier on, we don't credit score, so it is more of a manual underwrite. And as you can appreciate, when you credit score, it pulls through quite a lot of data that the high street then don't need to do the other underwriting, hence the reason why it's very black and white with them. Whereas coming to Kensington with our manual underwrite, we can get to understand what's going on with your case and your clients. So self-employed will look up to 95% as long as they've been trading for 2 years. If they haven't, we can still look at them, but we'll limit the LTV to 85%. Now, we always look at the latest year. We don't average whatsoever. It's always the latest year. And let's say, for instance, your client had a drop the previous year. That's fine, because the last 3 months bank statements will support what your client's New Year's trading is and the future trading, shall we say. So as long as it's not dropped again by the 3 months business bank statements, we're happy to look at the latest year, because the bank statements are still backing up that that client's still trading at that sort of level. We can look at company directors with their shareholding. So if you'd rather use their salary and net profits as opposed to their salary and dividends, again, we can look at that for you. Please just send in one or the other. However, if somebody's got accounts that were done, I don't know, June 24, but their tax return states that their dividends are much higher on their self-assessment, then please just send in the self-assessment with the higher dividends, and that's what we will work from. Also, if you've got a client who's moved from sole trader to limited company and they've not done their full year, that's fine. Again, we can look at those types of clients. So if you've got anything a little bit unusual, give me a call and we can have a little chat about where it fits with us, and I can give you an insight as to what the underwriter will be looking for. Contractors, we treat them very much like the high street, so it's day rate times 5 times 48 weeks, so we're a little bit more generous. We do want them to have a contracting history of at least 12 months. However, if they've got a CV showing that they were employed before and now a contractor, we can look at a slightly smaller, shorter periods. Things like complex incomes, you know, overtime bonuses, that sort of thing, we can look at 100%. However, don't just base it on the last 3 months average. You must look at the year to date and the P60. If it all stacks up, then we're happy to look at the 100%. We can look at second incomes as long as they've been doing it for at least 6 months. When it comes to agency workers, 0-hour contracts, we want a 12-month history. And if you have any CIS contractors, I think we're probably one of the best on the market, because we look at the whole 12 months. We don't average a certain percentage or just look at a smaller period. We're looking at their full year's trading. So again, we look at their gross income that they've earned as a CIS worker. So if you've got anything like that, again, you're a little bit unsure, I'm your girl to actually call. Can I call myself a girl? I'm not quite sure. So Heroes, we offer some products that offer higher income multiples, such as Heroes. This offers up to 5 times for emergency services and people in the education and armed forces. We don't mind what the second applicant does. It would still be a joint 5 times income. We have enhanced our professional range, where we've included vets and engineers, chartered engineers and chartered surveyors. So we've just made that a little bit bigger. And again, this is for your doctors, those sort of people. We can do up to 6 times income. So brilliant for your newly qualified doctors, because it just helps them get back onto that market, get into the mortgage market that little bit quicker. And again, for all you mortgage brokers, because I know you're classed as one of my high earners. So technically, although you don't fit professionals, I'm sure you'll sit in the high earner category. So anybody who singly or jointly earns over 100,000 fits under the high earners. And again, they can qualify for up to 6 times the income multiples. Please be aware that although Barclays have taken us under their wing, when it comes to foreign nationals, we're not as good as Barclays. So we're just waiting for them to share their little tidbit for foreign nationals. So I would say watch that space with bated breath, because it could be coming soon. But currently we only accept tier 1 and tier 2 visas. So if you have one of those, give me a call and we can discuss the criteria on that, because it is a little toppy, but I think it could help certain applicants. And that's me in a bit of a nutshell. So I will stop sharing. Don't know how to get back to my screen again, but hopefully.
Can I ask you a question, Maria?
Yeah, certainly.
What is the maximum age for a residential?
So we will only go up to 75 for on our residential, as long as they don't have as long as it's not a manual role. So otherwise it's state retirement, or we can push it to 70, 75, depending on the type of work that they actually do. If they want to do interest only, we'll only go up to age 70 for interest only.
Okay. And what is the income requirement for an interest-only residential?
So if it's interest only and it's 50% loan to value, there's no minimum requirement. If they want to go above 50%, then they'd need to be earning, one applicant would need to be earning 75,000. However, if your client wanted to do a 60% and they were earning, let's say 50,000, they could do 50% on interest only and top the rest up on repayments.
Thank you.
And again, as long as the downsizing looks plausible, then we've not got an issue. What we don't want to see is that they're going to go to Bognor and live in a caravan. Do you know what I mean? So bear that in mind, that if the equity in the property is plausible for them to buy a property, should anything happen day one, then we're happy with the sale of asset for the equity.
Great question. Thank you, Camelia. Andy is just, I think it's more of a comment, which is, I'm glad you've asked or commented on, Andy, just about the calculator in terms of a product finder, I think is what we're getting at in terms of a solution. So that is on the roadmap. I can't give you any timescales, but we are aware of it and we're looking into it. Yeah, thanks, Andy. Yeah. So I think in terms of like, I did the Who Are We piece at the start. We've always been I guess an innovator in the market, which we always try to do things a bit differently. That'll only get you so far, I guess. So we're proud of where we've been in terms of future direction. We're having a refocus on our core lending area. So Maria went through some of those. So self-employed, big part of what we do. High LTVs, big part of what we do. Buy to let, big part of what we do. How do we become actually easier to deal with in our core lending areas and actually bring them to fruition, because that's where we get most of our business. And if you think about how we're going to kick on and continue to grow, it's creating more certainty for you guys, really. So that's things like making it easier to find the products that you're looking for, etc. So thanks for that comment. It's something we're aware of, Andy, and it's something that we are proactively looking at.
But always feel free to give me a call, because I know it's like trying to go through a jungle of lots and lots of products and rates, and that's what I'm here for. So if ever you need some help, just drop me an email, call me, do both. I really don't mind.
And just to pick up, and feedback is so important. So obviously Maria will help you place cases, but also, if there are areas of the policy where you think that's really good, but if you just tweak that little bit, or you did this in this way, we would see more business, then feed it back to Maria, because I know the whole BDM team engage with products and risk, etc. So actually, your BDMs are a big tool in terms of pushing us forward.
Has anybody got any more questions at all?
We've got some comments being typed actually, so we've Camelia's typing a comment. Oh, thank you, Camelia. Appreciate you coming on today.
Thanks, Adam. Thanks, Maria. Thank you for your time.
And apologies for my phone going off as well. I should have turned my phone off. Apologies.
No worries.
Thank you so much for today.
Thank you. And thank you very much, Mahan, for letting me do this. That's lovely.
It's a pleasure. Thank you, guys.
Speak to you all soon. Take care.
Good luck for the rest of you guys. Thank you.
Bye-bye. Bye.